Hey, it's Darcy McConvey, and this is the Venture and Gains podcast. The purpose of the show is to connect people to other great people, ideas, and opportunities. Everyone has less than a handful of people in their network where it seems like there's something different about them. Everything they touch seems to turn to gold, and they're those can't-miss people, and you just know it. These are the podcast guests. We catch them at various stages of their career, learn from how they think, so you can connect the dots and apply it. Most importantly, we all want to meet more of these people, and we'll work to connect you. In this episode, CPS Capital co-founder Jeffery Tung takes you through his journey from software developer to starting his own private equity shop and how his hands-on, personalized approach sets him apart from the competition. Jeff co-founded CPS in 2013 with Michael Arblaster, and from 2013 to 2016 was the co-CEO of Windley Ely, in charge of operations and technology. Shortly thereafter, sprinkled in an amazing cannabis run. Prior to founding CPS, he was at McKinsey Company, where he led industry-shaping deals in telecom, banking, and utilities. Jeff, super excited to have you on the Venture and Gains podcast. Much sought-after guest. Your friend, but also an incredibly talented and sharp person, and someone you can sort of bounce ideas off of and rely on. So really glad you could make it. Thanks for coming.
Yeah, really appreciate you having me on here. Should be a lot of fun. Really looking forward to it.
So to set the stage, we're going to veer way away from a business conversation, probably a question you didn't want lobbed in first, but you grew up in Vancouver, and legend has it that you were a top foosball player. I've heard of foosball, but I never knew that there was a circuit and tournaments, and you were like the lead guy. You got to go into detail on that.
All right. I guess you've been reading the history books, eh? Definitely not a top guy, but I did play a lot of foosball growing up. I guess a fun fact is that foosball was absolutely huge kind of in the 70s and 80s. They used to have these huge tournaments. People were making, tens of thousands of bucks. And it was the thing to do until, I guess, arcades came along and killed it. Because, obviously you can fit, I guess a Pac-Man machine in about a quarter of the space. And it kind of died out. And then it kind of rose from the ashes. And it's pretty popular again today. So, yeah, I started playing in college and then found out that there was a bit of a circuit in Vancouver. And then started traveling a little bit as well. Definitely not, a world champion or anything like that, but did win a few tournaments back in the day, and it's always a good conversation starter for sure. So we'll have to get a game in sometime.
Yeah, I don't know how well I'd fare in that one, but do you sneak out at night and get a few reps in here and there?
I used to. My old roommate used to get woken up by me practicing my shot, but those days, not enough time for that. It's a little bit of work, a little bit of golf, and a little bit of gym is all I can hope for these days.
Yeah, I hear you. I know you're a busy guy, so on that note, why don't you tell me a little bit about CPS and the incredible work that you're up to?
Yeah, sure. Happy to. So CPS Capital, it's a small PE shop that was started by myself and my business partner, Michael Arblaster. And of course, Jason Fenn, who's joined us in the last few years. So we're a little bit different than your standard private equity shop. Really focus on, what we call the microcap space. So really businesses with EBITDA somewhere between 2 to 7 million. Our kind of average check size is anywhere from 5 to 25, 30 million. And really a couple of things that separate us. One, the size range that we focus on, we think is a real differentiator. A lot less competition in that size range, a lot of great value to be had. And myself, Mike, Jay, we're all operators at heart. So, while we definitely know our way around an Excel model, we really pride ourselves on being kind of operationally involved in the businesses that we invest in, kind of being there shoulder to shoulder with the entrepreneur, and adding a lot of value aside from just writing a check.
And so is your background in investing, like I know you're a McKinsey guy, you're a graduate in, I think, computer science. So walk me through your background a little bit and how you got to where you are right now.
Yeah, sure. Absolutely. Born and raised in Vancouver, did a computer engineering degree out there at UBC. I spent a few years as a software developer for a company called Business Objects, which was sold to SAP. It was a great job and obviously a really fun first job out of school, but felt that there was something a little bit missing for me, wanted to do something a bit more entrepreneurial or something a bit more, I guess, more oriented towards business, more broad-based. Did an MBA out here in Ontario at Ivy. Post MBA, did a few years at McKinsey. Did a variety of things, a lot of work in the PE space, supporting due diligences as well as a bit of portfolio company work. Did a lot of work in the telco space as well, kind of large transactions and contract negotiations. And quite a bit of ops work as well, which was really, I did some operating work, I guess you could say, in the software development world, but really at McKinsey is where I got my first real taste of operations, doing transformations, doing, cost programs, doing kind of large org changes. And then around that time when, you kind of get that itch to see what's out there, that 2.5 year mark, yeah, my buddy and roommate Mike was doing the exact same thing in banking, kind of getting that itch to leave, and we decided to raise a search fund. So if you're not familiar with the concept of a search fund, it's becoming quite popular now. It's really either a solo or a pair of searchers that raise some capital from high net worth people and kind of funds, and it's fairly similar structure to a private equity fund, but the big difference is that you're really looking for one business. Your backers are essentially funding your search, and then once you acquire that business, you kind of step into a full-time operating role. So we bought a company together, became co-CEOs, and then essentially ran that business, grew it, sold it, and then kind of continued on with CPS in a slightly different structure after that.
Yeah, I guess the search fund idea kind of originated in Stanford, right? It's, to your point, it seems quite popular, so especially post MBA, where you want that, I guess, sort of private equity / entrepreneurial experience. So how, when you think about search funds or searchers, it seems quite difficult. Like some large percentage of searchers don't ever find a business, right? So like, what was that process like? And, I'm sure there's a lot you can carry over from sourcing and acquiring that first business with Mike to today.
Yeah, absolutely. So yeah, it's a good point on the search. It originated at Stanford, like you talked about. It's still very much kind of associated and branded with that school. They do benchmarking, and I think they, every year they publish a report kind of saying how many search funds are raised, how they're doing, how many actually find an acquisition. And to your point, there definitely is some risk in that, you could spend a year or two and not find a company. But generally speaking, even people that don't end up making an acquisition find it a pretty worthwhile experience. To your point, there's a lot of lessons learned when you're kind of on your own as an entrepreneur, looking at businesses. You obviously see a lot of different companies and different industries in that 2-year period. So, definitely a great learning experience, I think, regardless of outcome. In terms of the training that it provides for what I'm doing today, I mean, it's, really, a lot of carryover, learning to kind of quickly analyze what makes a good business, what makes a good industry. A lot of our search was proprietary in nature. So, instead of relying on broker deal flow, we were picking up the phone, sending letters, sending emails, going to conferences, and basically trying to get in front of owners of businesses that we liked and basically convince them that we were the best fit for them, that, we were going to kind of respect their legacy, respect their corporate culture, and we'd be better than kind of selling it to a faceless PE shop, if you will. And that's really a lot of what we do today. I think, even though we are structured like a private equity fund today, CPS is investing out of a committed capital fund, just like, hundreds, if not thousands of other shops out there. We still take a very personal approach when we meet with owners. Again, we're very involved in these businesses. We really see ourselves as operators, and I think that really shines through in terms of the interactions that we have and the deals that we get done.
So if we step back to that first business, it was in claims management, I think, or, you can obviously go into more detail, but like what was the outcome and the timeline? And then you jump from there to the cannabis industry.
Yeah, that's right. So the first business, the company was called Windley Ely. It does workers' compensation claims management. So it's a relatively niche industry here in Canada, a much bigger one in the U.S., given the size of their economy and the fact that they're a bit more litigious and workers' comp claims there can be millions of dollars, while here there's a kind of a cap in terms of what the max payout is. Essentially what we would do is we worked for large employers, and we basically represented them and took their employees when they got injured through the claims process. So we would file the claim, we would manage disputes, and it was really kind of the perfect type of service that should be outsourced. So this is something that has a lot of complexity to it. Each province has its own regime. There's a huge amount of kind of cost associated with it. It can be up to, 10% of a company's payroll in certain industries and certain provinces. And if you do a good job versus a bad job, the savings or costs can be pretty significant. So, our general rule of thumb when we ran that business was, we wanted to make sure our clients were getting at least 5 times their fees that they were paying us in terms of financial returns. And of course, if you're able to do that for your clients, they're going to stick with you for a very long time.
It's a good metric.
We ran that business for just under 4 years. We ended up selling it to a U.S. strategic named Acrisure. The outcome for investors was basically about 5.5 times return on capital up front, with a few earnouts that really took it north of 6 when it's all said and done. Still waiting on the last one. Kind of fingers crossed for that. I think we're looking pretty good despite COVID. So definitely a great outcome for investors there.
So they were crossing their fingers that you went to search number 2, I guess.
Yeah, we've done a couple more deals since then, and in different industries. We think of ourselves not necessarily as completely industry agnostic. There's definitely some criteria that we look for, but we generally are willing to take a look at anything that's asset light, strong kind of recurring revenue or at least repeat revenue profile, good scalability, strong value proposition. That kind of financial ROI that we're providing our customers or clients is something that we always look for. And then you mentioned cannabis. I did take a brief foray into the cannabis space. I had the opportunity to co-found a publicly traded cannabis LP, so licensed producer. That was a lot of fun, being kind of on the forefront of a brand new industry. Really a once in a lifetime opportunity, because Canada was kind of very front and center globally when it was the first kind of major country to legalize it for recreational purposes. So that was a lot of fun, and definitely some good memories there.
This is a bit of a off the path, but are psychedelics the next cannabis or what?
Yeah, I mean, a lot of people would like to believe so, and there's a lot of companies being put together to try and take advantage of that opportunity, a lot of capital flowing into that space. I'd say that in terms of the medical usage of it, I'm definitely not an expert, so I definitely don't have a doctorate or any type of real credentials, but as far as I can tell, there seems to be a lot of clinical evidence that psychedelics are definitely effective for treating a variety of conditions. The one that's very front and center nowadays is things like PTSD and other types of mental health. So the trend for these alternative types of medicine is definitely here to stay. There's a bunch of clinics opening up these days and a bunch of push for legalization for medical purposes. I think there was a recent case where a couple of terminally ill patients were granted access. So I definitely feel like the trend is there for medical usage. As for recreational, I'm not sure. I think there's definitely a lot of recreational usage now. Society seems to be a lot more accepting of it. But that being said, I think it's pretty clear that the population that wants to use psychedelics is going to be smaller than cannabis. So I'm not the expert on this, but I wouldn't bet on recreational legalization anytime soon.
Yeah. So, one of the things I think that's super interesting about you is you can just hear it in how you talk is that you can cross over industries. Like your ability to evaluate is second to none. And it's just success, check that box, success, check that box, industry to industry, place to place, starting with foosball, which is a thread that I can't let go, clearly. But so, you've done a number of deals, done a number of things, and again, you've been successful and positive outcomes. But this is your first sort of big fund. So how do you, what's the story you tell? Call it a prospective investor. How you can, do a deal here, have success, a deal there, find success, and then, raise a big fund and manage multiple portfolio companies?
Yeah, no, it's a great question. And it's one that we get a lot because, obviously one of the first things that I talk about when I talk about CPS's investing style is how involved we are. So the natural question is, well, how well does that scale? Can you really do that and manage multiple portfolio companies at once? So I think, the first thing is that, it's not like that, even though we've raised a fund, now we're investing out of committed capital. It's not like we're going to go out and buy 5 companies all at the same time and try and juggle them all. There's a natural cadence to how you do acquisitions. And when you think about, your work with a portfolio company, helping them build out the right team, kind of diagnosing what kind of value levers to pull in order to, to really unlock that growth. All of those things are, fairly front loaded. And it's not to say that we just show up for the first 6 months or a year, then disappear. But naturally, you spend a lot of time with them. You learn the industry, you learn the people, you put together a strategy. And then after that, it's more about, kind of revisiting it, meeting with them and kind of course correcting as needed. So there's an element that, there's a natural cadence to these acquisitions, and that, we're not going to overextend ourselves. So if we find ourselves kind of knee deep in a couple of different companies, maybe we'll slow down the acquisition for a little while, and focus on operating. And, the second thing is that, really we're trying to institutionalize the model a little bit here. So the reason for moving to a committed capital model versus kind of continuing along the deal by deal track is that, we do have a management fee base we can draw from now. We're starting to build our team beneath us. And, just like how, Mike, myself, and Jay, we don't see ourselves as just investing professionals. We see ourselves as operators. That kind of same philosophy can be seen throughout the team. We have people that are not just interested in doing deals and running deal processes. We have people that are genuinely enthusiastic about operations. They're keen to not just find great businesses, but work with them and unlock that value. So that's really the culture that we want to build, and kind of that investing philosophy, if you will.
So if I'm a business owner, I've run a business for however many years, and I'm thinking about selling, and the CPS crew comes along, Jeff, Mike, and Jay, like what's the differentiating factor? Because I could imagine, like I think about, you've run this business, and yeah, you guys are great guys, and you'll operate well, you'll treat, the people at the business well, and I'm sure this is part of your sales pitch. Well, I guess it's an assumption, you can tell me, but like, why would they pick the CPS team over someone else?
You've definitely hit upon a lot of the pitch, or a lot of the points, in terms of, you're going to get investors and people that really care about your business, that really are going to take the time to learn your industry. While we do have a lot of experience, our big thing is that we don't come in with some preconceived notion that we know how to run your business better than you, that we can just copy and paste from another company or another industry and find success. There's an element of, you want to be experienced, but you also want to show a level of humility and humbleness to the operator and owner. So there's kind of walking that fine line where you have credibility, but showing a lot of deference and respect. And then beyond the fact that we have a track record of doing so, we're more than happy to have them talk to people that we've worked with in the past, so they know that we're not just weaving a tale about being involved, that we actually do these things. I think a couple other differentiators are, we're investing a lot of our own capital, so we're the largest investors in our fund. I think if you look at the percentage of CPS that's committed by the GPs versus a lot of other funds out there, the proportion is quite a bit higher. I think a lot of owners really resonate with that. I think there's the general idea that you treat your own capital very differently, or potentially differently than you might treat your investors. So that goes a long way as well. And I think, it's really just a gradual process, right? It's not like you're going to wow them with a single meeting and a nice PowerPoint presentation. It's getting to know them, putting in the work to understand their industry, understand their business. And then over time, you really build that credibility. And more often than not, the fit with CPS seems like a good one for them, and we're able to get something done. So
like, if you think about the value gap that can potentially bridge, so say it's a $20 million acquisition, and someone's bid 24, like what kind of gap do you think that approach can bridge, or is it tough to say?
Yeah, it's, it is a bit tough. It's obviously situation specific. And, I'm not going to tell you that, I'm so charming and so nice that, someone's willing to give up millions of dollars just to work with us. I think that would be, I think a bridge too far and a little bit, arrogant of me to say so. I think, when things are close, and we're talking about, a marginal difference in valuation, we're often able to kind of bridge the gap in other areas. So, for instance, because we're going to be involved in these businesses, we can oftentimes convince and of course demonstrate to owners that we're going to add a lot of value to the business. So in a situation where the owner is interested in retaining a piece of their business and rolling some equity, obviously they're going to put a lot more stock into the team and what the long-term plan for the business is. So that's oftentimes, a big differentiator there. It helps kind of tip the scales in our favor. We're also pretty flexible when it comes to things like structure, when it comes to things like earnouts and then participating in other ways. And again, just being responsive, kind of reading between the lines, can oftentimes unlock a lot of value. So, I'm not going to tell you that, hey, we can buy for 20% cheaper than the next guy just because we're nice guys. That's not true. But we can definitely get structures that work really well for us, that are capital efficient. And in the scenarios where, we are talking about a proprietary deal, one where it's not brokered and we've just approached an owner and are convincing them that we're the right fit. If you can avoid them going to a broker and wanting to run a wide auction, then in those instances, of course, you can definitely unlock a lot of value. But again, owners, when they're working with us, it's not like they should have the expectation that, hey, we're value purchasers or we're not going to pay a full price. We definitely will, but just in a way that really works well for them and of course prevents us from overpaying, if you will.
You talked about flexibility and structure, so I'm curious to know, like what those levers might be or things are. But before we get there, a lot of people are wowed by, I think, this idea of, being in private equity, and it sounds to me like it's roll the sleeves up and not easy work. So I think to be successful, you obviously have to be super passionate, just love business and love like so many different facets of business, which seems to me that, you definitely are. And I think your whole team is. I know how hard you guys work. So it's kudos to you. But back to structure. What are some of the levers? And you say flexible in terms of structure. Like what are some of those things? If you can just give some high level examples.
Yeah, absolutely. I think, each owner situation is going to be a little bit different. Some of the unique things that we've seen along the way as differentiators, obviously kind of their personal tax or personal financial situation is oftentimes, a big one.
You're talking about the owner's personal tax.
Yeah, exactly. Yeah. So, the easiest example, of course, is something like an asset sale versus a share sale. Sometimes they want to dispose of things over time to kind of defer or structure the cash flows over multiple years. Things around letting them hold on to a percentage of the business. Things that we've also seen are, sometimes they have family members or close friends employed with the business. So making sure that they're taken care of and that they get a shot at, essentially growing and essentially growing their role, becoming senior leaders. That's something that we've worked with a lot as well. Yeah, really every person's a little bit different. I think for us, we pride ourselves in being very flexible. If we find a company that we like and we can agree on a fair price, everything else we're pretty flexible on and we can use that to get a deal done.
It's kind of this, I don't know if it's been emerging for a while, this idea of almost a permanent capital approach, right? Like you hear of single family offices or family offices taking this approach, which is like incentivize current management, take a stake and kind of treat people well and, grow the business together.
Yeah, absolutely. The idea of these kind of permanent capital or evergreen structures are definitely becoming more popular now. And it's actually something that we got pushed on a little bit from some of our LPs on, hey, why are you using kind of the traditional, 5-and-5 model in terms of a 5-year deployment and 5-year hold for the fund? Why don't you explore some of these newer structures out there? I think for us, what we found is that, the market right now is at varying levels of maturity. So you have people that have been investing for a long time that really understand the idea of permanent capital. Obviously you get to compound wealth for multiple years. And of course, everyone knows the power of compound interest. And on top of that, you don't have redeployment risk. You don't have tax drag and things like that. But those are really people on, I guess, the very mature end and very sophisticated end when it comes to these family offices. A lot of the kind of the newer family offices that are out there, they're much more used to fixed term type instruments and the knowledge that liquidity is going to come. And, again, thinking about things in a more, I guess, simpler fashion, if you will.
Yeah, it's an interesting concept. That's for sure. So walk me through, you acquire a business. What are some real quick wins that you typically see, like things you can do right away? Is it putting in systems? Is it HR? Is it incentives? What are some of the quick wins that are like part of the playbook per se?
Yeah, I'd say that there's nothing that's completely universal. There's definitely a lot of patterns, which I'll talk about. But we, again, don't want to go in with a full set of, hey, this is what we think is wrong with your business and how we're going to run it better than you. Oftentimes we will spend, the first 3-6 months not making any major changes and really just learning and observing, and then over time start to introduce things. But some things that are common problems that we see, one is use of technology and investments in technology. I think oftentimes when you have an owner operator and all the money is essentially theirs, they can oftentimes, I don't want to say be cheap, but be quite watchful of investments in things like IT and tech. Simple. It can range from really simple stuff like people just not having new computers and them wasting productivity on just waiting for things to load and just not getting stuff done in an efficient manner. Even the first business that we bought, for instance, it was a very paper heavy business, a lot of documents, a lot of filing of things. Nobody there had 2 monitors, for instance, and there's plenty of studies out there that show that 2 monitors increases the output of that work like that by 20, 30, 40%. And
I guess maybe I should get a second monitor then.
And given the monitor's a couple $100, probably pays for itself in a couple of weeks. So that's a really simple example. And then, slightly kind of moving upstream a little bit, oftentimes these businesses are a little underinvested in their ERP, their CRM, the telephony systems and things like that. So that's one area. Sales is another really big one. Oftentimes in these types of businesses, the owner is one of the best salespeople in the business. They're the most senior, they're charismatic, they know the product or service very well. And sometimes you get into situations where, they've been unable to pass along that skill set and really hire and build a great sales and marketing team underneath them. So that's oftentimes an area that we like to invest in, like to work with them on trying to build out that function. Aside from that, I think, you'll see different things in different businesses. Oftentimes, businesses are pretty efficient in some ways. Owner-operated businesses, they tend to be able to keep salaries quite low. They have a very personal relationship with a lot of their employees. So sometimes there's some work that needs to be done there in terms of making sure people are fairly compensated. Sometimes you'll show up and people, because they know that it's a new owner now and they don't have that personal connection, that raise that they've been wanting, they're a lot more apt to ask for it, and you have to budget for that as well. And then, on the financial side of things, there's usually some benefits to unlock there as well. Again, that's an area where a lot of owner operators tend to underinvest. They might have, an accountant or a bookkeeper doing a lot of the work, but, no real CFO level talent is pretty common. So, understanding the profitability of their business, understanding the profitability of individual clients, business lines, of course, efficient use of capital and things like that are, again, not universally things that we can improve upon, but are oftentimes levers that we can pull pretty early on in the process.
There's a lot there. In the case of like a CFO or, building up the sales team, that's where your sort of operational excellence comes in to help build that out, or are you sort of bringing in someone to do that?
Yeah, it can be a combination of the two. So we do have a lot of those skill sets internally within the kind of the partnership that we have, as well as the team that we're building. So that allows us to really hit the ground running in terms of being able to execute right away. We can kind of do some of the heavy lifting ourselves. Of course, over time, you want to build that capability within the business and let them stand on their own 2 legs. So you can't fill that role or fill that gap forever. But having that expertise, 1, allows us to, again, hit the ground running. 2, if you have somebody leave or if there's a gap that suddenly pops up, we're able to step in and plug that hole, effectively, and then again provide that bridge. And then, longer term, hiring the right people, bringing in consultants as needed, all those things are definitely things that we're able to do.
So who are your typical sellers? You hear oftentimes, people that are close to retirement and don't have a succession plan. But, given the times we're in today, you also have sort of this turmoil via the pandemic. And I can imagine that many of the sellers are people that have been through a downturn or two before and don't have much zest left or gas in the tank to do it all over again. So 1, who are the sellers? And 2, how has, the pandemic and sort of the downturn and, the unknown future impacted or helped, your acquisition strategy?
So you kind of nailed the first group of sellers with your question there in terms of, the people that are nearing retirement might not have a succession plan for their business and of course need to transition it. That's kind of the stereotypical situation that you run into where, they essentially, need to pass on that business. In terms of how that's changed with the pandemic, it hasn't really changed too much. I think early on in the pandemic, when there was a ton of uncertainty, the market kind of froze up a little bit and not a lot of people were trying to transact. But that's since changed. So long as you're in an industry or looking at industries that weren't too impacted by the pandemic, people are transacting now, and it's almost business as usual, I would say. Of course, if you're in something like something related to tourism or something related to like the restaurant space, I'm sure there's still a lot of uncertainty there and things aren't transacting. But you have owners that want to exit of all shapes and sizes. We've definitely done deals and transactions with people that are much younger that definitely aren't retiring. But sometimes people just want to change. I mean, building a business for 5, 10, 15, 20 years can be very exhausting. And, sometimes they just want to see what else is out there. They want to take their foot off the gas because they've been working 80-hour weeks. So there's a lot of different situations that you could find yourself in. And then beyond the situation where, it's a full transition, more often nowadays we're backing kind of entrepreneurs that, just want to take some chips off the table. Maybe they're looking to bring in new partners to help them grow. So we're looking at quite a few deals right now where, we're not replacing the CEO or not replacing the owner. We're really just letting them take a few chips off the table, de-risk themselves, provided them with some additional resources to help them bring to that next stage of growth, and really think of it much more as a partnership.
Yeah, like as you're talking about it, you almost think, or you wish that for many business owners, they would have the access to, guys like you earlier on, so that they don't run into, the end of the line almost and say, okay, now I got to sell, like enough's enough, or I'm a certain age and I can't, right? Like you almost, instead of doing it at 65 or 70 or whatever the age is, you wish they could have access to it at 45 or 50 and kind of go on a run with the team.
Yeah, absolutely. That's the ideal outcome, right? When that you're working side by side with them, you're both mutually building equity and creating kind of financial value. Those are the kind of the win-win scenarios you're always looking for sure.
So you guys are Toronto based. Are most of the companies you're looking at based in Canada, or is it North America, or what's the sort of geographic reach?
Yeah, we're investing in both Canada and the US. Historically, most of our deals have been Canadian. Right now, if I was to look at the deal pipeline, it's roughly a 50-50 split. So obviously, we're Canadian based. We have a really strong network up here. There's way fewer funds doing what we're doing up here. So we're going to be overweight Canada relative to the size of the economies. But that being said, the US is obviously a great place to invest in. Lots of businesses that need to transition, that want to transition. A lot of other resources to tap into. The number of lenders down there is enormous that you can tap into. We do a lot of proprietary searching. So if we find industries or little niches that we like, Canada is not a huge place. So if, we call up the owners in that space and none of them are in the market or want to transition, then of course we'll naturally take that thesis to the US.
On that little niche, unless it's your secret sauce and you don't want to give it away. What's an example of one of those? Going back to that first deal that we ever did, the claims management one, we like that space a lot. There's a lot of adjacencies to it. Workers' comp, of course, is when injuries or disabilities happen in the workplace. There's a whole parallel industry that does disability management. So, short-term disability claims, long-term disability claims. It's an area that we like, and hopefully we'll transact in it again. And again, that industry is, much smaller here in Canada than it is in the US. Again, don't want to oversimplify things and make it seem like the two markets are the same. They're very much not. Each state in the US is almost like its own little country, but that would be an example of a thesis that we could take both north and south of the border. Didn't you become like an expert and a keynote speaker? I don't know, maybe I'm blowing it out of proportion, in the insurance claims management space inside like 2 years. Am I fluffing up that story a little bit, or what happened there?
You're probably talking about some of the actuarial work and kind of understanding how claims cost translates into employer rates and things like that. Really interesting topic, and I use that example sometimes when I'm talking to an owner on why CPS is different. So, not to spare your listeners the boring details, but if you're a large or a mid-sized employer in most provinces and you have a lot of injuries, your rate goes up. So you're experience rated. So it's not a free ride on the insurance system, if you will. And of course, the incentive is to make sure that you provide a safe environment for your employees and manage their injury well. Each province has its own system and way of doing experience rating. And because it's a relatively small industry, there's not a lot of financial experts in the space. The person that we bought the business off of, so the company was Windley Ely, Sam Ely. He was probably one of the top, if not the top person on that topic, and it was a really big value driver for the business. He had a couple of people that worked for him that were pretty strong, but in the first few years of running the business, I wanted to make sure that we downloaded as much of that knowledge from him as possible, and that when he ultimately, of course, went into retirement, that the customers and clients that we had wouldn't be able to say, hey, you lost such a big resource, maybe we should start looking elsewhere. So hit the books, broke out the Excel models, and got really good at the topic. And it just so happened that Ontario, our largest province and where the most kind of premium dollars flow, was undergoing kind of a large framework reform is what they call it, but basically overhauling the entire experience rating system. And because of that, it was a real opportunity to try and flex those muscles. We represented a lot of our clients and a lot of non-clients in terms of advocating for what we thought was best, making sure that our opinions were heard, doing a lot of modeling to make sure that in the new system that we would be optimizing things as well as we were in the old system. So yeah, really interesting topic. And again, is a great example of something that kind of sets CPS apart, that we're willing to really get our hands dirty and understand the industry. We're not just going to read a couple of reports and, attend a few conferences and think that we know enough to invest and advise you on how to run your company.
Yeah, that's impressive stuff. Sounds like lovely bedtime reading.
Exactly.
What you're digging into. So how big is, if we look at Canada, how big is the market of these SME type businesses that you're looking at?
That's an interesting question. I mean, obviously, Statistics Canada, keeps track of, how many small businesses are out there. And, the number is probably, in the high tens of thousands or low hundreds of thousands if you were just to look on the website. Of course, a lot of those are too small and, not really in scope for us, because you're going to have a lot of things like, restaurants or kind of owner, like really kind of, single sole proprietor type businesses. So it's really tough to get an exact handle on what would be in scope for CPS. I would say that there's definitely in the thousands of businesses that meet that kind of size criteria and are probably in industries that we like, and maybe even in the tens of thousands. And of course, you can easily multiply the number by 10 to 15 for the U.S. That's part of the investment thesis, and that's why there's a lot of value to be had here, because there are thousands of business owners that need to transition that might not have a plan for their business, and there's not that many buyers.
Yeah, I know we've kind of hit on this a couple of times, but I can imagine just putting an effective plan in for that business owner is huge value. It's a sense of relief. It would be it's tremendously valuable outside of the fact that you're going to hopefully treat people well going forward. Like that's a huge value prop for sure. So what is like a typical investor in CPS? How big is your fund? Where are you at with the fund?
Yeah, so the target fund size is $75 million. We're just doing our first close now. It'll be around 40 for the first close, and there's a bunch of people kind of hanging around the rim and that are not quite over the finish line yet. So we think a second close will be done in the next few months and get us most of the rest of the way there. The average investor are either kind of family offices or high net worth people. I think the story's really resonated a lot with them. As I'm sure a lot of wealth in Canada was created through entrepreneurship. The majority of our investors have likely gone through an exit or two of their own, and they're able to relate the struggles of perhaps finding the right partner, that transition, and they see the value in what we're doing, and it makes a lot of sense to them.
Yeah. And so I actually want to step back to thinking about how do the lenders look at it? Like, what are the equity requirements, and how are, is it sort of Sketch A banks lending to this, or how does that, how does the sort of financing side work?
Yeah, there's and this is an area that's really interesting, and it's getting more and more. There's more and more options kind of emerging all the time. So, the big five banks in Canada definitely lend on cash flow to businesses in the size range. It's very impressive how far they've come in the last 10 years in their comfort level and ability to underwrite. Beyond them, there's a number of other options in Canada, and in the U.S., it's a whole other ball game where you have banks, you have large funds. You have individual family offices underwriting lending to the space. But in Canada, yeah, you definitely have the big five banks. Smaller banks will do it as well. You have some private debt funds, mezz debt funds. You also have things like BDC as well that are oftentimes great at supporting Canadian-owned businesses and want to help support through transitions.
And so what would be the equity requirement in a typical transaction?
Yeah, that's a good question. I think it definitely varies, especially since, we at CPS typically don't max out the leverage that we're able to get. So while we do use some leverage and it definitely helps with equity returns, we tend not to try and create all of our value through financial structuring. And, a lot of our returns are underwritten by, the improvements that we can make by growing the business, et cetera. So for us, we usually put, 2 to 3 turns. So 2 to 3 times EBITDA of debt on a business would be kind of the median, if you will. And then the balance would have to come from equities. So, if I was to say that the average deal gets done somewhere between, let's say 5 to 6 times EBITDA, then you could just back out the 2 to 3 and that's our equity check.
Gotcha. If I'm an investor in CPS, which full disclosure I am, what can we expect from your team in terms of, returns, whether you want to go into returns or not, communication, and just, keeping people apprised of what's going on?
Yeah, in terms of reporting, this is an area that we really try to go, I would say above and beyond for our investors. It's obviously there's your basic reporting where you're, you report on the NAV of the fund and, where you are in terms of, drawing down capital and kind of the fund accounting. But beyond that, we really like to show our investors kind of how we think about industries, give them a lot of detail on the businesses that we're investing in, and give them a lot of detail on what we're doing with these companies, like who we're hiring, what kind of capabilities we're trying to build out, what we're excited about, what are the growth opportunities. So we really like for our investors to feel like they're really along for the ride and they're not just getting kind of a statement out there. In terms of returns, obviously we all know that I can't say that we're, guaranteeing X types of returns. Can't really read out a disclaimer right now, but we typically try to underwrite every deal to at least a 35% IRR, which is, obviously a lofty hurdle. I think it helps a lot that in our size range, again, valuations are a lot more reasonable and a lot lower than in kind of the mid-market or upper market of private equity. So that's kind of how we kind of baseline things. And obviously, a number of things can go wrong or a number of things can go right. So, luckily all of our previous funds and deals have returned well north of that. But of course, who knows what the future holds. I feel good about it, but, you never know.
Well, you're a great team to bet on, by no means is that a promo, but, just hearing the effort and the energy and the passion, like it's no easy task. So wish you luck. That's for sure. So you're currently looking for businesses, so if there's any obviously listeners that would entertain a conversation, they can connect with you. Your contact info and stuff will be in the show notes, but is there anything else that you kind of want to throw out there before we wind it down?
No, this has been great. It's been a lot of fun to tell the story. Obviously I'm really passionate about this kind of, asset class, if you want to call it that, but I really enjoy, what I do. And yeah, if anybody wants more information or wants to chat, please don't hesitate to reach out. And again, that invite is not just to prospective investors or to prospective sellers, really anybody that, wants to ask questions, learn more about the space, interested in doing, a search fund or something similar. Again, I always love kind of meeting new people, having smart conversations, and of course, having fun.
If I could say one final thing, I think you're, like I said, obviously sharp, but also super generous with your time and always insightful and, running ideas by you. Like it gives it gives me a sense of confidence, no question, when kind of, I hear your thoughts and insights. So it's good that you threw that out there because you definitely have a very unique skill set. That's for sure. So Jeff, appreciate you and your time. Wish you guys all the best and best of luck and keep it up.
Yeah. Thanks again for having me. It was a lot of fun. Again, always love telling the story and look forward to catching up.
You bet. Thanks, Jeff. Your time is valuable, so thanks for joining us for this episode of Venture and Gains, where we connect great people, ideas, and opportunities. It's this idea of net weaving versus networking. Remember that you can find more episodes at ventureandgains.com. And if you know any entrepreneurs, emerging asset managers, or fascinating people that you think would be a good fit, flip us a note and let us know. Stay well.
Darcy McConvey is a director of private capital markets at Greybrook Realty Partners and is registered under Greybrook Securities, Inc. The opinions and statements expressed by Darcy and the Venture and Gains guests are their own, and they do not reflect the opinions of Greybrook Realty Partners or Greybrook Securities. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.